Welcome to the Market Screener, a breakdown of what matters in the stock market for investors in the week ahead, so that you can keep up on the news while keeping a focus on what matters long term. I'm Daniel Schwarzman, your host. We open August with leading U.S. stock indices still hovering near all-time highs. Despite all the headlines you've seen about the Delta variant or inflation, investors remain buoyant. One possible explanation is that earnings have been stellar compared to expectations. According to FactSet, with almost 60% of S&P 500 companies reporting earnings already, we are on pace for the highest percentage of earnings surprises and the fourth highest magnitude of earnings surprises since FactSet started tracking that data in 2008. 88% of companies are beating estimates so far this earnings season. Whatever else is going on, earnings are what drives stock prices long term, and they've been pretty good so far this year. That said, there are still questions being raised in this earnings season to the point that markets actually dipped last week. I think there are three questions in specific that you may want to keep an eye on beyond tracking the stocks that you own in your portfolio. Start off with COVID Hangover. Q2 2020, which is what we're lapping now, was an extraordinary period, as you remember. It was our first full pandemic quarter, and lapping it makes for weird comparisons, with some businesses having amazing performance last year as everyone rushed online, and others barely keeping the lights on as they're forced to be shut down. So for COVID winners, the question for months has been, what does a growth slowdown look like, and when does it happen? We got hints of that in last week's big tech earnings. From a market perspective, Facebook, Apple, even Microsoft, who had a really strong quarter, and especially Amazon, finished the week at their lows. Let's take Amazon's report as the best example. The company beat on earnings, but missed on revenue, with their number only reaching 27% year-over-year growth, which, after 4 straight quarters of 37% plus growth, was a bit of a slowdown. Their guidance is for 13 to 14% growth at the midpoint of their guidance for next quarter, which, given their $100 billion revenue a quarter company, is impressive in absolute terms. But compared to those stronger numbers in the last 4 quarters, it looks a little less impressive. So the question is, where does Amazon go from here? Can they maintain any sort of growth, or are we really starting to see their limits? The irony with Amazon is that the stock is actually only up 5% in the last 12 months. And on the inverse side, it's only back to about early June levels, so it's not exactly a huge sell-off. Couple companies to watch for that trend this week. Etsy is an obvious one. The handcrafts and small shop online marketplace reports Wednesday after market close. They already had their COVID hangover hit after Q1, where they had underwhelming guidance of 15 to 25% growth. Again, good on its own, but compared to 125% plus growth for 4 straight quarters, not so exciting. They also took another dip on Amazon's news last week, but they're above where they sold off to after Q1, so we'll see what the market's pricing in. And what they're saying about the quarters beyond is we're into a little bit more of a normal environment. Wayfair is another player in this general category, online furniture retailer. They report Thursday morning. You can make the case that Wayfair has a better chance of thriving given that different parts of the economy, like offices, are sort of reopening. But the company said on their Q1 call in May that they were trending high single digits decrease on gross revenue at that point in the quarter. So analysts are expecting them to underperform, to actually do less revenue than they did a year ago. And again, the question is, what's priced in for both of these names? I'd point out that Wayfair is actually down 6% in the last 12 months, and Etsy is up only 3.15% year to date, though much more in the last 12 months. It did well in the last half of last year. So those are 2 to watch on the COVID hangover front. The flip side of that is, where are we with the offline recovery? The Delta variant is cropping up in the States and elsewhere, and there's fear that it will derail our recovery in sectors like travel and entertainment, as well as industrials and so forth. Last week, we got one big vote against that narrative, as Boeing's earnings report cited a remarkable recovery in U.S. travel and green shoots elsewhere in the world, and the company turned a profit for the first time in a long time. Remember that Boeing had the 737 MAX crisis before the pandemic. Other airlines and travel-related companies have given strong reports and promising guidance for the rest of the year, so it feels like travel is close to back. We'll have a better idea of that when Booking Holdings and Expedia report this week. The two travel leaders, along with newcomer Airbnb, which reports next week, report Wednesday and Thursday, each after the market close, respectively. Booking is considered the market leader, and full disclosure, I own Booking shares, and is especially focused on Europe, so we should get a sense of how the recovery is going there and whether any of the recent outbreaks are slowing that momentum. Expedia has been undergoing a bit of a transformation, so we'll get a progress report on that, but they should also be able to give us more of a focus on the US market beyond air travel to see how persistent and widespread the travel recovery is. Of course, another sign for our overall economic recovery is the jobs report, which comes out Friday. It'll give us the month of July non-farm payrolls report. Investing.com's number shows 900,000 jobs are expected in the report, which would be an increase on 850 reported in the June report. Employment is a major focus for the Fed, which leads to our last question in earnings season. Inflation has been the buzzword in 2021, and the jobs report should give us an idea of how persistent and sticky wage growth is. But company earnings have and will again shed light on this issue. Last week, Procter & Gamble mentioned cost inflation and freight inflation hitting them for $1.9 billion in the fiscal year that's coming up for them, which goes from July to June. They still feel they can grow earnings 3 to 6%, which is better than their revenue growth, with some price increases to offset and some productivity measures in place. They just finished their fiscal year 2021 with $14.3 billion in earnings. So for stronger companies, there's a way to hold ground. On tap for this week, then, is Kraft Heinz. They report Wednesday morning. They're famously run by 3G Capital, the Brazilian private equity company, with Warren Buffett's Berkshire Hathaway as an investor in KHC. The zero-based budgeting model that Kraft Heinz and 3G Capital are known for is meant to keep things tight to the bone. Question is, how does that hold up with inflation coming into the picture? Kraft Heinz is guiding for a mild decline compared to 2020 sales. They admit their COVID hangover up front, but mid-single digits growth from 2019. They didn't sound too worried about inflation on their Q1 call. Consumer goods is an obvious area to see that sort of inflation, so we'll see where they end up here. Okay, that's this week's Market Screener. Get in touch with Daniel at shortmanseries.com if you have any feedback or requests for next time out. I hope you found this useful. I hope you stay safe out there in markets and otherwise. And final disclosure, I'm long Berkshire Hathaway and Booking Holdings. All right, good luck out there.